really due to the convergence of a number of factors, and two main factors in particular. The first key factor building up to this was a very active real estate market. A great deal of development, a lot of money was flowing into real estate development, especially in the realm of condos and city-type properties. And reinforcing that was a sub-factor, a migration of the population to the city centers in the US and worldwide. In fact, last year was the first year that more people worldwide were living in urban areas than are living in suburban or rural areas. So we have this very active market on the one side, and on the other hand, we have the emergence of very lenient, at least in terms of historical lending standards, very lenient lending standards, especially in real estate lending. And it's important to point out that these two things are very much reinforcing of each other and cyclical. So we have this more relaxed lending, and the way that's kind of rolled out over the course of history is starting in the mid-1990s, we have the emergence of subprime lending. And essentially what defines subprime lending, at least from a very strict technical point of view, is all that real estate debt issued to borrowers that federally backed organizations won't accept as prime lending candidates. Federally backed organizations such as Fannie Mae, Freddie Mac, and Ginnie Mae, and the Federal Home Loan Bank. So these are subprime candidates. So on the one hand, it's a good thing that we have the emergence of this product, and what differentiates those people as not being prime is really a question of risk. At least risk is defined in terms of credit score and things like debt-to-income ratio, and specifically income-to-housing expense ratio. In the past, we have prime mortgage products that people with very good credit and very good income-to-debt ratios had access to buy real estate. But now, coming in the 1990s, we've got this group of products really, that are for the purpose of serving those people that have less than stellar credit, and frankly, not as much income. And compounding this, exacerbating the amount of risk that was taken on. International investment capital increased over this time period, especially from early 2000, 2001 to 2006. During this period, we have an increase from about $34 trillion to approximately $74 trillion in investment capital. And it's the law of supply and demand. If there's that much money supply, there's got to be a place for it all to go, and there's really no other way. To compound that, the U.S. mortgage market was actually one of the most lucrative markets during this time, at least in terms of returns, dependable returns. In the background, of course, the question in hindsight as to whether that was a rational decision to put all this money or not is somewhat questionable, but that's the way hindsight is. Essentially, the system was banking on a U.S. real estate market continuing to appreciate almost indefinitely. And of course, that's not going to happen. But at the time, like any other financial crisis, no one can predict the future. And everyone is playing along because everyone is making money, and that's another factor. The lenders in this market basically looked next door and saw their competitors were being a little more lenient, a little more free and loose with their money, and managers said, well, hey, they're making money, more money, why aren't we doing those things? Why aren't we doing that? So you have this matching, this kind of one-upsmanship, almost an arms race, if you will, to the point where you actually have, which seems somewhat ridiculous now, but you have 0% down, no documentation loans at very low interest rates that are 100% financed in many cases. Anecdotally speaking, we've experienced at least one situation which really illustrates the abuse of the system. A 19-year-old person, unemployed, with really no employment history and really no income to speak of, getting financed for a property at over $400,000, fully financed, 100% leveraged. So this is kind of the perfect storm of circumstances, and as you know, the market reaches towards a crescendo. You got people on both sides, both the supply side in terms of the real estate products, as well as the lending side, and they're both pushing the envelope more and more to make an extra dollar. And eventually things break. So what we have starting in the early 2000s is a situation where there are a lot of loans out to people that have questionable ability to pay, at least in the long term. In a really hot real estate market with more and more development projects coming online delivered. And it's hard to recognize at the time, but this turns out to be something of a precipice, because as the price in the market starts to cool even a little bit, and prices get a little bit soft, the house of cards gets really shaky and eventually starts to fall apart. One of the unique things about the real estate market is that supply reacts very slowly with respect to demand. So if demand falls off just a little bit, these projects that were started a year ago, they keep coming to market, and they've got to go somewhere. Someone's got to buy them. So this is eventually what we see happening. Prices start to fall a little bit, inventory on the market goes up a little bit, and as people want to sell quickly, they need to change the price level for a given neighborhood and lower the price slightly. and in a given area, this feeds upon itself. As a few prices drop, it tends to reset market values in the neighborhood because people have an emotional relationship to price, like, I want to get the lowest price of the last sale. So if there was a sale that was a little cheaper than the previous one, that's what people relate to as the new market price. So that's one of the factors going on here. This leads to a very sticky situation because a lot of lending is predicated on appreciation at this point. If you get 100% financed on a house, and by the way, most of these properties do not have mortgage insurance because they have two mortgages in an 80-20 position, that is 80% first mortgage and 20% home equity line, which also, by the way, relieves the need for private mortgage insurance. But as prices begin to fall, people don't have liquidity and they can't refinance now because they don't have the equity in the home to do so. There's no appreciation at this point. In the past, they've been able to bank on their appreciation and get a little cash out through refinance. Essentially looking at the house as a piggy banking, shaking it from time to time to get a little equity out. Well, too many people had done that to the point where there was nothing left. And many new houses were bought with nothing left to begin with. So that's kind of the beginning of this house of cards starting to fall. And as defaults go up, banks respond by really reining in their lending. And a compounding factor to this, of course, is the way the banking system works.